I start the video? When do I start the video? When do I start the video? When do I start the video? Do I start the video now? Well, how about now? Maybe now? How about now? Hi, I'm Peter Rose, founder of Longwood Currency Trading, and this video is about when to take the Forex trade. And it's very similar to when do I start taking the video. It's when I'm ready, and when the conditions are ready, when the camera's ready, when I'm ready. So when do you take the trade? There are two conditions that I'd sort of like to talk to you about today. They're general conditions and are not indicative of a rule. They're just a general discussion of, well, when do you take that Forex trade? Preliminary to talking about those two things is you don't take the trade or any Forex trade until you have the proper education that enables you to craft rules with conditions that enable you to transition from phase to phase of what I call the life cycle of a currency position, which is entry analysis, position management, and exit methodology. I was a software engineer for 33 years. I know how to solve complex problems. And the way that you solve a complex problem is you break it down into through a bunch of smaller, simpler problems to solve. If those problems require more than one rule to work with, then you break that problem into two problems until you have what we call encapsulated and loosely coupled problems that chained together in a sequential manner will solve the overall problem. And that's what the life cycle of a currency position does. You got to enter the trade and figure out what that analysis is. That's why it's called entry analysis before you do anything. You can't have a position to manage until you enter the trade. So there's a sequential movement from the entry analysis to the position management, and then finally exiting the position exit methodology. So those are the three problems that I address in my fast track course, which is a 6-week program. And you get through all that shit in 4 weeks. And then the final 2 weeks is used to taking the metrics you've learned from your trading and applying them into the conditions that your rules are based on that form the framework of the solution set for the life cycle of a currency position. And you find that in your trading plan. And there are 3 sections to the trading plan. So we talk about organizing all this information, culling it down into what I call relevant information, codifying that information as rules which are condition-based. And those conditions are sequential. If condition 1 is true, then you can move on to condition 2. If condition 2 is true, you can move on to condition 3. If condition 3 is false, you're done. You do not execute the rule. You only execute the rule when all of the conditions for that rule have been met. It's very Boolean. It's very simple. It's either yes or no. It's not analog. There's no, oh my God, the sun's not high enough in the thing, and I'm waiting for the NFP to come out. No. These are not analog decisions that you can make as a trader. You're either doing something or you're not going to do it. And the entry is part of that. Well, when do you take that Forex trade? It's as the beginning part of the video. When do I start the video? When do I start the video? Well, I was going to start the video when the condition was met that I was warm inside, because it's a chilly late October 2025 day. And I'm not going to sit out there in the wind and do a video today. So the conditions was I had to be inside in a well-lit place, and I'm comfortable, and I'm very comfortable. I've got my coffee, and I won't bore you with drinking coffee, but I've got that, and I'm set up here in this beautiful kitchen in this 1775 antique cape that we live in, with a view out over the grounds. And you can see in the background that the trees are finally beginning to go from yellow to golden colors. And when are they going to fall? Well, when the conditions are necessary. And they are beginning to fall, as you saw in the video. We're starting to have some leaves fall. So everything is a process. Everything is condition-based. When the leaves are dry enough and they're brown enough and they're brittle enough and a wind comes up, they'll fall. So when do you take the Forex trade? And there's two conditions. First, the price action has to be with some kind of general trend. And second is when the momentum is good. You don't want to take a trade against the general trend unless, now there's a bunch of subcategories we could go into today, but all I want to do is talk about the simple shit, okay? When do you take the Forex trade? With the general trend. And that's where the conditional parts of it come. What trend are you talking about? Are you talking about the daily trend? Are you talking about the 15-minute trend? Are you talking about the 1-minute trend? Well, isn't that conditioned on the time frame that you're trading on? And so when you're looking at doing your trading, in taking that trade, you have to base that trade on the general trend and all this other ancillary information that I've just provided for you. But for the trend itself, it's in relationship to the time frame that you're trading on. You want to get enough candles such that it represents candles that actually affect what potentially could be going on today. You know, we're again in 2025, and the Forex market is $7.5 trillion a day. That's a shithouse full of cash flowing around. And so when you are looking at participating in that market, there's tremendous ability to go back not too far and see where you have maybe not swing points, those aren't really the relevant points, but more of the points where you have what you would call a level, a support or resistance level due to structural constructs within the price structure itself created by order flow. It's those constructs that indicate the limit the price is going to go, for example, up. I don't call those support and resistance levels, I call them boundary conditions, because they're boundaries on where you can expect your price to oscillate from. So do you want your boundary conditions when you're looking back in time to, let's say you're a day trader and you're planning your trades on the 15-minute time frame, you're executing the trades on the 5-minute time frame, and you're managing them at turn points down on the 1 minute. So that's the body of immediacy that we're going to work with during that 2-hour time frame, is the 15-minute down to maybe 1 minute as a day trader. Oh, there's too much noise on the 1 minute. That's the point, is that when you're down on the 1 minute, you can find out where the noise is, because when you see noise, it indicates a change in the momentum of your price and your trade, and so you exit. That's the second condition, when the momentum is good, right? But we're talking about the general trend. So do I need to know when I'm in that trade what happened 6 months ago? No. The $7.5 trillion a day market means that there are billions of dollars transacting within. How long does it take an institutional trader to unwind a $2 billion engine part order or a $10 billion engine part order? He's not going to do it in 15 minutes. Even though the market is so huge, he can't do that. He's got to dribble that out over time, because not everybody, all the other institutional traders, have a $10 billion compensating trade that they need to make. And so the trader has to dribble some out. And when the price gets up to one of those boundary conditions, one of, say, a resistance line, the guy that's buying the currency pair doesn't want to pay any more for it than that. He stops. So the trader stops because his client doesn't want him to pay more for the parts than that. So when he stops and he's created that buying, then the price is going to begin to retract. There are indications and rules, and we talk about those in Fast Track as to why that happens and how far you can expect that to go. Not the point of this video. But when you're looking at the general trend, it's 6 months ago doesn't matter. Maybe last month doesn't matter. So maybe because we're executing off the 15-minute for our profit targets, our stop points, our, if you're doing building and staging, you're determining those off the 15-minute, because when you're staging, you're expecting the price to go basically beyond the profit target. So that you need to know, well, what is really affecting that 15-minute time frame? Well, again, the guy that's got this $10 billion order is doing it over a series of days. He doesn't have 6 weeks to do that, because who knows what the prices are going to be in 6 weeks. And the traders, they could hedge, and there are certain institutional traders that are doing that. They're hedging their positions, but they've got the bank right there with other traders doing the opposite trade in the pair, and so they can begin to hedge. But that slows them down. You can't wait. You can't wait 4 weeks, because in 4 weeks, price could have moved 500 pips. You know, I'm looking at one of the pairs that in the major pairs, and we've gone up 200 pips and down 200 pips, and we've done that 3 times in the last 2 weeks. That's a lot of activity. You could say, well, now you're trading in a range rather than in a trend. And that would be true as far as the order flow is going, because you can see that there's some big activity going on. And if you look at the economic conditions, interest rates beginning to come down, inflation reducing a little bit, unemployment going up. So we got all these manufacturers and folks that are trying to balance their orders with the current conditions. I don't want to pay more than this, and I'm not going to sell my shit for less than this. So then you've got this range. So you could say, oh, great. Well, I've got this range over the last, say, 2 weeks. I should be looking at the weekly chart then, or I should be looking at the daily, well, what's the daily trend? No, I don't think so, because you're looking at too many days. You're relying on what happened. Let's say it takes that guy a week or 2 weeks to unload his $5 billion order or whatever. He's just playing into it because the range is tight. So you got 2 or 3 weeks, and you don't have any real trend in that. Okay, well, before all this massive thing started, what was the trend? That's where you find these flag patterns and these other things, and they don't mean anything, and I don't teach flag patterns and stuff. What I teach is process, and the process is what I'm going over with you now in figuring out what the general trend is. Sure, there's a trend within the range-bound movement, even though it's not trending over that whole period. It's going up and down. Each one of the up and down things is a trend, but it's too short of a trend, perhaps. If you have a 300 pip boundary and you're going to be trading 2 hours a day, and the ATR on your pair is 80 pips, I'm not real sure that you want to rely on the trend in that range-bound motion. So what would you go? You'd go back to maybe the 4-hour chart, or maybe you would go back to the daily. What was it doing before this range-bound section began to do? Oh, it was a rising trend. People were rising to it, and now we've got all this congestion here. So that could indicate one of two things. Either when all these orders get done, that rise in price is going to continue, or that could be an inflection point and the price could then turn around and go down. But you don't really give a shit about that because you don't know what it's going to do. You only can look at what it did. And so you could say in your head, gee, the general trend should probably be somewhere before I ran into this range area. And so I'm going to just use that as the general trend. So that's what I'm talking about. How do you determine the general trend? When you're looking at playing a trend in the 2-hour time frame that you're going to be trading, how far is price going to move in 2 hours? Oh, it might give you 20 pips. You might get 50 pips out of it if you got an economic release that's going or whatever. But generally, on a major pair, your daily ATR is 80 to 120 pips on a daily basis. But unless you have a strong trending market, you're not going to see that happen in 3 15-minute candles, right? It's going to be over the long term of the position that you're going to be hopefully in at that time. What's your boundary condition? How close are you to your boundary condition for where that may stall out? How does that factor in with the general trend? The general trend is short and you're ending up in this stagger. Then even though you're down at the bottom of the range, would you trade that to the long side? Yeah, I don't think you would. Those retracements are basically the institutional trader stopping for a little bit, letting price come down so he can get a better price. So the video is not about that internal range condition boundary trend that you're on. That's a whole other issue that we're going to be talking about. What I'm trying to say is, how do you establish the probability of the general trend? Price was moving up until it got to this range-bound motion, or price is just continuing to move up and you're in a trend. That's the general trend. Okay, so let's move on to when the momentum is good. But when the momentum is good means that when in your analysis process, in the entry analysis phase of the life cycle of a currency position, or if you don't believe in that, you don't want to do it, you still have to analyze the entry, right? And so you have to look at when is that price moving sufficiently that you're not going to get a flip and a retracement, even a 5 or 8 or 10 pip retracement, because that might signal a stop event. You know, you get into the trade and it goes up and then it retraces back to almost where you got it. You don't want to go into negative, and so you cut the trade and then it turns around and goes up 40 pips. So you have to have a condition and a rule that determines, first of all, what would be a good momentum, and from a probabilistic standpoint, when are we going to see that momentum occur? You don't see momentum happening all the time. The gun doesn't fire all the time. It goes, you might have a machine gun that goes pop, 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 but it's not a continuous movement. It's sequential. It's piecemeal. And so your momentum is going to be the same thing. You step on the gas in your car and you go a little bit faster, and the car begins to slow down a little bit, and then you step on the gas and you go a little bit faster. So what candles are you determining your momentum should be on? And how do you view what momentum is good enough to last from the entry point that you take to wherever you're saying that you want your profit target to be, and you've got a stop set there so that if it gets there, bing, you ring the bell and you're out and you go to home and you go to work. Remember, we're not talking about doing 50 pips a day. In 2 hours, you're not going to do 50 pips a day unless you happen to trade in an NFP or something like that. And then you could easily lose 150 pips just like that. So you don't trade those types of events. We're talking about the normal day. You got 2 hours, maybe an hour. You step down. If you, what I try to do in the fast track course is enable the student to be able to do what I do, which is I open up the trading platform and I pull a chart up and I look at it. And in 15 seconds, I know, is there something I need to sit down right now and act on? Is there something that is potentially going to be there, and so I got to go brush my teeth and get a cup of coffee or whatever and get back so that I can do a reanalysis thing? Or is there just nothing that's going to happen in the reasonable future and I can just forget trading for the day, or maybe wait until evening or something? Or if you're working, I don't work, I'm retired. But when I was working and I saw that there was nothing that could be done in that 2-hour period of time because of what are the current momentum and price action and all that shit. I mean, I teach this stuff in the course. But in 15 seconds, you can look at that chart and you can make one of those 3 determinations. So the next thing that you're actually going to look at when you actually sit down to do your analysis, that isn't part of the entry analysis. That's just, is there anything to do today? Okay, so you got to learn how to do that. And then you got to learn entry analysis. And that's where your momentum comes in. What's it done in the past? How often? What's the periodicity of the momentum? Just like if you have a sine wave, you know, that goes like this. What's that periodicity from peak to peak, let's say, in your momentum changes? And so that you're looking for that price to move. Price is moving in the direction and you say, oh, I got to get in right now. Yeah, but if you get in right now, that momentum may die off and you may be caught in a downswing. And then you have to make a determination. Do I get out? Do I lose the pips that I've gained and let it go to my take point and get out there and just zero out? Or do I risk it and let it go the 10 or 20 pips to the panic stop, hoping that the thing will turn around and continue to go up? You don't want to be in all those kinds of decision processes. That makes it tough to do. So your entry conditions, again, need to stipulate when you're talking about momentum is that what's the periodicity of the momentum and what is the expectation for the momentum distance over the 2-hour time frame I'm going to be here in order to get to my profit target. And so when do you take the Forex trade? You take it when you're confident that you understand the general trend. And number 2, when you understand the probabilities are in your favor for the momentum. If you have any questions about this stuff, I'd be happy to get an email from you. We can chat about it, no charge, even a video conference call. I have a free PDF file, the 7 steps of successful Forex trading. Send me an email requesting that. Be happy to send that to you. Or we can set up a video conference time. Just talk about your situation. I don't have a course to sell you. I have a course that you could buy if you'd like it. I'm not selling it to you because I don't have enough time. I'm retired to work with 20 people that really aren't interested in replacing their job income. I'm only working with a small few number of people that watch the channel and know about me, and that's fine. We'll work with that. So don't be afraid I'm going to try to sell you anything. Send me an email and let's discuss all this stuff in maybe more detail. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.